Imagine it's a Tuesday morning. You're retired. No alarm, no commute. You wake up whenever you want, and for a moment, it feels exactly like you imagined it would. And then you check your phone, not for emails from a boss, not for a meeting reminder. You check it because you're genuinely unsure which account you're supposed to pull money from this month to cover your bills. You have a 401k, you have a Roth IRA, maybe a taxable brokerage account, maybe some cash sitting in savings, and you've worked your entire adult life to fill these buckets. But no one, not your HR department, not the financial magazines you half read, not even the retirement calculator you used in 2019, ever clearly told you which bucket you're supposed to open first. That moment of confusion? That low-grade anxiety on what's supposed to be a peaceful Tuesday morning? That's what this video is about. Because getting this wrong, even slightly, could cost you tens of thousands of dollars over a 20 or 330 bar year retirement. And getting it right doesn't require a finance degree. It just requires understanding how the system actually works. So let's walk through this together. Here's the thing most people get wrong about retirement withdrawals. And I say this without judgment, because the financial industry doesn't exactly make this easy to understand. Most people think about retirement savings in one big pile. I have $1 million saved, or I have $600,000 across my accounts. They picture it as one number, one pool, and when retirement comes, they plan to just draw from it. But here's the reality, that money isn't all the same, even if the dollar amounts are identical. A dollar sitting in your traditional 401k is fundamentally different from a dollar sitting in your Roth IRA, and a dollar in your taxable brokerage account is different from both of those. Why? Because of taxes, not in some abstract, complicated way, in a very real, practical way that affects how much of your money you actually get to keep and spend. And the psychology here is interesting, because we're wired to simplify. Our brains want to treat a dollar as a dollar. It feels rational. It feels clean. But the tax code doesn't care about our cognitive comfort. It has its own rules. And those rules, if you ignore them, will quietly drain your retirement over time without you even noticing. There's also this other mental trap a lot of retirees fall into. They immediately go for the account that feels the safest to touch. Usually that's their regular savings or their taxable brokerage, because it doesn't feel like they're cracking open their retirement accounts. They want to preserve the 401k for as long as possible. Let it grow. Don't touch it. I get it. I really do. That instinct comes from decades of being told to protect your retirement savings. But in retirement, that instinct can actually backfire. And that's where the conventional wisdom starts to unravel. Let's talk about what's actually in each of these buckets and why it matters. Your traditional 401k or traditional IRA, any account you contributed to with pre-tax money, is essentially a deal you made with the government. You got a tax break when you put the money in. But when you take it out, you pay ordinary income tax on every single dollar. It doesn't matter if it's been sitting there for 30 years growing. The moment it hits your bank account, the IRS treats it like income, like you just got a paycheck. Your Roth IRA is the opposite deal. You paid taxes on that money before it went in. So when you pull it out in retirement, assuming you're over 59 and a half, and the account has been open at least 5 years, it comes out completely tax-free, not tax-deferred, tax-free. That's a real and meaningful difference. And then your taxable brokerage account, the one that isn't wrapped in any special retirement label, sits somewhere in between. You've already paid income tax on the money you contributed, but when you sell investments inside it, you potentially owe capital gains tax on whatever growth you've made. And importantly, long-term capital gains are taxed at a lower rate than ordinary income for most people. That rate could be 0, 15, or 20% depending on your total income level. So when you're in retirement and you're deciding which account to pull from, what you're really doing is choosing which tax rate to trigger. And that choice has compounding consequences over a 20 or 33 bar year retirement. Here's where the conventional wisdom, spend your taxable accounts first, let your tax-deferred accounts grow as long as possible, starts to look less like wisdom and more like a default setting that nobody really questioned. Let me give you a simple example to make this real. Say you're 65, newly retired. You need $60,000 this year to cover your expenses. Social Security is covering $24,000 of that, so you need to pull $36,000 from your accounts. If you only pull from your traditional 401k, that $36,000 gets added to your income. Depending on where you live and your total picture, you could end up in a 22 or even 24% federal tax bracket. And there's something else. If your income gets too high, more of your Social Security becomes taxable. So you're not just paying taxes on what you withdrew, you're also paying more taxes on the income you were already receiving. It creates this quiet spiral that most people never see coming. But what if you pulled some of that $36,000 from your Roth? Zero taxes. What if you pulled some from your brokerage account, from investments you've held long-term, potentially taxed at 0% if your total income is low enough? These aren't loopholes. They're the system working exactly as intended, for people who understand it. Now, there's another layer to this that I want to spend a moment on because it genuinely changes the math for a lot of people. It's called a required minimum distribution, or RMD. Once you turn 73, and this age has shifted over the years with legislation, so worth double-checking where it stands. The government essentially says, you've deferred those taxes long enough. Now you have to start pulling a minimum amount out of your traditional accounts every year, whether you want to or not. And if you don't, the penalty is steep. Here's why this matters for the withdrawal order conversation. If you spend your entire retirement pulling only from your taxable and Roth accounts, your traditional 401k keeps growing untouched, which sounds great, until you're 73 and the government forces you to pull large distributions, potentially pushing you into a much higher tax bracket than you'd ever planned for. Your Medicare premiums might go up. More of your Social Security becomes taxable. The bill arrives whether you're ready for it or not. So counterintuitively, for many people, the smart move is to do some strategic pulling from your traditional accounts in the early years of retirement, even if you don't need the money, to keep that balance from ballooning into an RMD problem a decade later. This is sometimes called a Roth conversion strategy. You take money from your traditional account, pay the tax on it now while you're in a lower bracket, and move it into a Roth. You're essentially choosing to pay a smaller tax bill today to avoid a larger one tomorrow. And the years between retirement and age, 73 can be a golden window to do exactly that. I want to pause here because I think there's a deeper realization hiding inside all of this. We spend our whole working lives being told to save, max out your 401k, automate your contributions, don't touch it, let it grow. And for 30 or 40 years, that's exactly the right message. But retirement is a fundamentally different game. The rules flip, and the skill set that made you a great saver doesn't automatically make you a great withdrawer. These are two different disciplines, and the emotional transition is just as hard as the technical one. There's this thing psychologists talk about called loss aversion. We feel the pain of losing money more intensely than the pleasure of gaining it. And in retirement, that shows up as this deep reluctance to spend down your accounts. People watch their balance drop after a withdrawal and feel a quiet panic, even if the withdrawal was completely planned and reasonable. That panic can lead to bad decisions, pulling from the wrong account, over-withdrawing from one bucket to avoid touching another, or on the other extreme, living too frugally because the balance going down feels like failure. And I think that's the real turning point here. Understanding the withdrawal order isn't just a tax strategy. It's a framework that lets you spend your money with intention and confidence. It lets you look at your retirement and say, I know why I'm doing this. I know which account, why, and roughly what it means for my taxes this year. That knowledge is calming. It turns a source of anxiety into a source of clarity. So what does a thoughtful withdrawal sequence actually look like in practice? Let me walk you through the general approach that many financial planners use as a starting framework. And I want to be clear, this isn't one size fits all, but it's a solid mental model. The first place most people start is with any income that's already flowing without you having to touch your investment accounts. Social Security, pensions, rental income, part-time work if that applies. Use that first. Let your invested money stay invested for as long as reasonably possible. Next, many people look to their taxable brokerage accounts. The gains here are typically taxed at the lower long-term capital gains rate, and in some cases, if your overall income is low enough in those early retirement years, that rate could be zero. So you're potentially spending money in a very tax-efficient way. Then, during those early retirement years, particularly if you've retired before 73 and your income is relatively low, this can be an ideal time to do partial Roth conversions from your traditional 401k or IRA. You're essentially filling up the lower tax brackets intentionally. You're paying taxes now at a lower rate to reduce the RMD burden that's coming later. Your Roth IRA, in most cases, you leave for last, or you use it strategically when you need income but don't want to bump yourself into a higher bracket. The Roth is your tax-free reservoir. It also passes to heirs in a very favorable way, so preserving it as long as possible often makes sense, but not at the expense of creating a giant taxable RMD problem. One more thing I'd encourage you to think about. The year matters. A year when you have a big medical expense, a year when you sell a property, a year when markets are down and you're rebalancing. These are all moments when the optimal withdrawal source might shift. The framework isn't rigid. It's a guide that you revisit. And if you haven't already, running a rough tax projection each year in retirement, or working with someone who can do it with you, is genuinely one of the highest value uses of an hour you'll find. I want to leave you with something that I think gets lost in most retirement content. You saved this money. You showed up for decades. You made sacrifices and trade-offs, and probably had moments where you wondered if any of it was worth it. And now you're at the point where that money is supposed to work for you, where you're supposed to feel the payoff. The withdrawal order conversation isn't about being clever or gaming the system. It's about making sure that the money you worked so hard to accumulate actually reaches you. As much of it as possible, for as long as possible, without unnecessary friction or unnecessary taxes, quietly eating away at it. And here's the reassuring truth. You don't have to get this perfect. A rough understanding and a decent strategy will serve you far better than either. Ignoring the question entirely or paralyzed by trying to optimize every single dollar. Progress, as always, beats perfection. And the fact that you're thinking about this, learning about this, that already puts you ahead of where most people are when they walk into retirement. The Tuesday morning you imagined, peaceful, unhurried yours, it's still available to you. You just want to make sure you're pulling from the right bucket when you need it. Take care of yourself.